Waiting on my orange light. There's my orange light. All right. Now, all of this had to be done, right? How many of you are right now ready for the feature presentation? Yeah. All right. You all brought your pen and papers. You're ready to get some great golden nuggets. Well, you know, Paul, we have a tradition here, but looking, I already see you back there.
Wait, you went to the back where we sent you there.
You know what? That's okay, Paul. Can I have you go outside the white door? There's always a way to get them, right? So, today our guest speaker is going to be Paul Alpert. He's a CPA and Consulting Services. And Paul's going to be discussing with us some basic aspects of our tax system. I mean, right now we're in tax season, right? Let me hear you moan. It's okay. Who here likes taxes?
Christy.
You know, I do.
The financial advisor likes tax season, yeah.
So you know, some people do not understand tax season correctly. I'm one of those. When it comes to taxes, Mom, you're doing my taxes. Right? Oh yeah, I do. I put it on the spot, Christy. Oh wait, that's on video. Oh man.
Sorry, man. I'm not going to edit that.
He will also explain to us how some business people can save on tax using a C corporation. You know, so Paul has an MS degree in taxation from Golden Gate University. He's been in private practice for 22 years. 22 years, that's a long time to be in the industry, right, Lynn?
Pretty taxing.
So, at this time, if I can have everybody stand up, and I want you to get as loud as you can, and help me welcome Paul Alpert!
Did you want to move that a little bit forward?
Yeah, I did. Thank you.
Sure.
I won't be able to use the mic.
That's okay.
Do you want to move the table further out there, Eric? And then we can use the mic? Come on, Eric, give me a hand.
Right.
There's two tables.
Okay, so, you know, I'm a CPA and accountant. Here I am out of my shell on the big stage. Now, accountants, as you know, are known to be boring people. This is not quite accurate, and I'd like to correct this misconception. Accountants are people who are interested in some boring topics. It's a very subtle distinction. You got to think about it, you know, for a few days. Okay, so I wanted to, in this talk, address one or two misconceptions a lot of people have about the tax system, and then explain how some people can save tax using a C corporation. Let's see. Okay, so here is the marginal rate of tax. What is the marginal rate of tax? It's your highest rate of tax. So in this example, the income here is, well, this line represents $1 above the 25% bracket for a single person in 2011. So the income is taxed $8,500 at 10, the next at 15, the next bracket is at 25, and only that $1 is taxed at 28%. A lot of people think that if they earn too much money, they'll be thrown into a higher tax bracket, and they'll pay that rate on all their income, so they're better off, you know, not making that extra money. That's not the way it works. So you don't have to worry about that. Okay, let's see. Here are the brackets again. 8,500, up to 8,500 is taxed at 10, 34,500 at 15, and then above 34,500, it's taxed at 40.3. Okay, remember this number here, 40.3. I'm going to use that as an example. That's kind of a typical, above 34,500. Oh, you got those rates there, but if we're talking about self-employment income, you've got to add on self-employment tax. The 1040 form involves two taxes, income tax and self-employment tax. Self-employment tax is FICA and Medicare. A self-employed person pays both halves, which total to 15.3. Okay, now, hold on a second. Here's the C corporation has tax brackets of its own, unlike an S corporation. A C corporation pays tax. And the first bracket is the first $50,000 at 15%. So you begin to see how there's an opportunity here to save tax. If you're paying 40.3% on your income, on your top rate of income, you could be paying 15% with a C corporation on some of that income. And by the way, this strategy I'm talking about is described in this book. It's a famous book, Ink Yourself. 25th, more than 500,000 copies sold. This is actually out of date, we're on the 10th edition. Anyway, it's a very popular book. Okay, so here's how you do it. It's called income splitting with a C corporation. And by the way, most CPAs, or many CPAs, will tell you that an S corporation is the way to go. But I disagree with that in many cases. Okay. So in this example, your income after expenses is $70,000. That's what would go on your Schedule C if you were a sole proprietor. But with a corporation, you can take a salary. So, and that leaves $20,000, $50,000 salary leaves $20,000 in the corporation where it's taxed at 15%. So this is up to you. I mean, you can zero it out. A lot of CPAs will do that. They'll take a salary of 7 so that there's no tax. So this $20,000 stays as retained earnings. It's taxed on Form 1120. That's a C corporation tax return. And this $50,000 goes to your 1040. It's taxed on your personal return. Now you say, well, why would I want to leave money in the corporation? Isn't that double taxed? At some stage, I've got to pay 2 rounds of tax. That's what a lot of CPAs will tell you. I should say here, I'm not talking about very profitable corporations, hundreds of thousands of dollars. They're probably better off as S corporations. But I'm talking about modest, people with modest profits. Okay, so what can you do with that cash in a C corporation? Working capital. Working capital, you can think of it as cash. And cash is king. right? That's a famous expression you've heard. Cash is the most important thing to any business. It's the most important figure on the balance sheet, either that or working capital, and that's what we're talking about here. So, you can pay down debts. Loans payable, including shareholder loans, loans you've made to the corporation, credit cards, accounts payable. What that means is that if you spend, let's say you get carried away with your spending, and you build up a credit card balance, and you can't pay it off, you're paying interest of 19%. You can pay down that balance with money taxed at 15% instead of money taxed at 40.3 in my example. That means the cash flow is better to the C corporation. That's a big deal, in my mind anyway. You can also pay your federal income tax with that cash in the corporation. If you're a sole proprietor, you've got to pay it with money tax at 40.3%. But here you pay it with money tax at 15%. You can also possibly make a larger retirement contribution. You've got more cash to do that with. Other tax savings with a corporation. Down here. Not there yet. Okay, with a corporation, a C corporation, you get a much better medical deduction because as a sole proprietor, all your medical is reduced by 7.5% of your adjusted gross income. And that's a big number, adjusted gross income, that's your total income. So it's normally wiped out completely by that reduction. And here's a very important point. A sole owner without employees is not subject to the anti-discrimination rules. If you've got a corporation with employees, you've got to do for them what you do for yourself. If you're paying all your medical through the corporation, you've got to pay all their medical. And you probably don't want to do that. But a sole owner corporation, he doesn't have anybody to discriminate against. It's not a problem. He just pays all his medical and through the corporation and gets a deduction. Another advantage of having a corporation is you're far less likely to be audited because when you're a sole proprietor making, say, $100,000, you're a big fish in a small pond. And the IRS doesn't like sole proprietors. People ask me, well, is the home office a red flag? Is this a red flag to the IRS? Schedule C is a red flag to the IRS. They consider that an area of abuse. And they go after Schedule C much more than other returns. It's roughly, well, it's greater than 1%. It's not a high number, but there it is. It's much greater than other returns. With a corporation, you're the small fish in the big pond, and you're very unlikely to be audited with a corporation. So that's good news. Okay, there is one fly in the ointment, and that certain people are not allowed to split incomes in the way I'm describing. And those are these people: lawyers, accountants, health professionals, doctors, dentists, performing artists, and here's the biggie: consultants. If you call yourself a consultant, then you fall in this category. However, if 5% of your activity is not personal service activity, you can get out of this problem. This is an anti-avoidance provision of the Internal Revenue Code. That means they're stopping some people from employing this strategy because I think it's because they view that these businesses don't require capital to run. But I don't really agree with that if that's what it is, because as I was saying before, cash, any business needs cash, and you need, ideally, a lot of it. $50,000, $100,000 in the bank would be wonderful, so that you can, weather, a rough patch. What else we got? Oh, yeah. Almost there. Well, which businesses can benefit with a C Corp? Insurance agents and brokers, they're selling a product. They're not providing a service. Real estate mortgage agents and brokers, sales and manufacturing reps, financial planners, and then a whole bunch of other businesses. I can give any the list. On and on and on. Okay, here's my contact information. Paul Alpert, CPA, DBA 1040 Land.
Great name.
Thanks. 1040land.com. Telephone number there. Here's an interesting quote from a judge by the name of, it's got a strange name. I've been trying to come to grips with his name for years. Learned Hand. Anyway, he said, anyone may arrange his affairs so that his taxes are as low as possible. Nobody owes any public duty to pay more than the law demands. Let's see, where is that? If you can refer me any business, I pay 15%. 15% of what I charge the person, I'll pay to you. $300, I'll pay you $45. Oh yeah, when you have a corporation, people worry about, well, I got to keep minutes of the meetings and the cost of the it's not expensive. I can form a corporation very cheaply, a one-person corporation. The minutes are a trivial issue. I can show you how to do it. Okay, so in addition to tax and accounting, I have a side business where I manufacture and sell calendars and day planners. I bought some calendars. It's a bill reminder calendar, which I'll give out to anybody who's interested. And if you want to take a look at the best day planner in the world, see me afterwards. I've got some up here. Thank you very much. Thank you so much, GNA, for allowing me this opportunity to speak. I really appreciate it.
Any questions? Tax questions. You're gonna have questions, buddy.
Yeah.
Is it possible for you to advise somebody how to set up a C Corp? Or is that necessary to go to a lawyer to do?
No, that's what I said. I can do a C Corp for very cheaply. We don't need a lawyer to do it.
Okay.
Yes.
Anything to do with the minutes or any of that crap, you don't need a lawyer.
You do LLCs?
LLCs, yeah.
What happened to the alternative minimum taxes? Did it go through and get extended again, or did it go?
Oh, the alternative minimum tax is very much here, alive and well. Yeah.
Difference between the S Corp and the C Corp.
Right. An S Corp is a little bit like a partnership. And in a partnership, you do a partnership return just to figure out how much income each partner is allotted. And then they get a Form K-1 that shows the income. It's like, kind of like a W-2, but it's longer, more involved. And you pick all that income up on your personal return, your 1040. So the partnership doesn't pay any tax, it's just a reporting entity. Same with this S corp. It's a little bit of an oversimplification, but that's basically how it works. You got it? No?
Come see him afterwards.
All question back here.
Yeah.
In what way is paying off your personal debts or medical bills different than paying yourself a salary? How is that okay to do that from your retained earnings in the corporation? And why is it different than paying
Okay,
yourself?
you cannot pay your personal bills other than medical, because a corporation can have a medical plan for its employees. And if you're the only employee, then, it's your medical bills that they're paying. It's like, there's a line on the corporate return that says employee benefits. It's not part of salary.
So it's paying down corporate debts.
Well, yeah, if it's a debt, yeah, sure.
Under benefits, can you have other things like an IRA that the corporation pays into that you can also pay into?
Well, you can have not an IRA, but you can have a retirement plan. Yeah, that might be a good idea. Yeah, a 401k plan, for example, yeah, you can probably close to $50,000 a year, depending on your income. Somebody else?
Yeah, I know Schedule C is a more tempting to put in more expenses, and it's an eye opener for a IRS examiner. The
Yeah.
question is, the bottom line is it advisable to pay the highest or more self-employment tax so that by the time you retire, you'll be getting more Social Security?
Okay, yeah, that's a good point. Yeah, if you do this income splitting and what you're doing is, in my example, you're taking only $50,000 instead of 70, then you're not getting full credit for your Social Security, and your benefit would be somewhat reduced. However, depending on where you are and what age you are, that reduction is not going to make a lot of difference if you're older. A few years of a slightly lower salary is not going to affect your benefit very much. You'd have to look at it carefully if you're younger, because it might affect the benefit. It's true.
So it is advisable that 10 years from now you're going to be getting Social Security. It's advisable to max your self-employment tax payment.
No, I don't think so. If you're going to get Social Security within 10 years,
Yes.
that means you've been working for 30 years, but you have to, no, that's not right.
Say you're 55, something like that.
Yeah, well, it's 55, but if you've been working since you're 20, let's say, 25, you've been working 30 years, that record is there, and it's not going to be affected that much by the last 10 years. And you can look into that, and I think that, yeah, I'm pretty sure that's true. Okay?
Time for one or two more questions. Any other questions? All right.
Oh, yeah.
Would you offer a free consultation to GNA?
Yeah, free consultations. I offer free consultations, sure, in general. Okay, so here's these calendars. I'll leave them on the back. Sal. One customer. By the way, this calendar is kind of unique because it's called a bill reminder calendar. And it's got a way of tracking your credit card and other monthly bills, so that, you don't miss out and get stuck with late fees. But instructions. And, you know, you might screw up the first month or so until you figure out how it should be working. But it works for me. Thank you so much again.
To Paul, please round of applause! Come on, Paul! Thank you to the great helpers here from the table. Before we close the meeting here, let's do this. Before we close the meeting here, just want to let you all know that next week here in San Jose, how many here know who Rob Brown is? Rob Brown from Morgan Hills, great, fantastic guy. He'll be making the speaking debut in the GNA here next week, so come and check it out, support him if you can. On that note, we're going to close the meeting now with upcoming